What's up, everybody? Welcome back to the Stock Trades YouTube channel. My name is Dan Kent, one of the co-founders of stocktrades.ca. In last week's video, we dove into a very interesting dividend stock, a Canadian dividend stock for viewers. I'll leave a link up top if you want to watch that. But this week, that video was so popular because of the dividend content, I imagine. Obviously, our readers and watchers love dividend content, so we've decided to bring you more of it this week. In this video, I'm going to go over 3 dividend plays for your tax-free savings account in 2022. But most importantly, if you want a particular set of content, a particular topic to be talked about on the channel, just head down into the comments and drop it into the comments section. We look at and reply to pretty much every single comment. So if you have a video idea, don't hesitate to drop it in the comments below. But let's get started. 3 top Canadian stocks for your tax-free savings in 2022. Let's go. So before we get started on the video, I just want to remind you that if you like this video and drop a comment down below and subscribe to the channel, you will be entered into our February draw where we give away a premium subscription worth $300 a year at the end of the month. So we did this in our last video. We announced a winner and we also went over another excellent top Canadian dividend stock and Stock Trades premium pick actually in A&W Royalty Fund. So again, I'll drop a link up above to that video. But with this video, I want to speak on the TFSA in general, and the number one issue I see with a lot of new investors investing inside of their TFSA is they're often taking on way more risk than they really should with this account. Now, the one thing a lot of investors don't understand is that once your TFSA contribution room is gone, it's pretty much gone permanently. If you get $6,000 to invest this year and you buy some nano microcap stock that plummets in value and you end up selling those stocks and losing, say, $5,000 out of the $6,000, that contribution room is gone permanently. You don't get that $5,000 loss back. The next year, you'll simply get your next year's contribution room. And if you take a lot of risks inside the TFSA, it can end up in some life-changing losses in terms of overall returns. I've personally known people who have blown over $30,000 in their tax-free savings account, lost that room permanently because they took on way more risk than they should. So in terms of my strategy, what do I personally do inside of my tax-free savings account? Well, I invest in strong Canadian dividend payers. I don't invest in US payers inside of my TFSA because they are subject to withholding tax. So my TFSA is strictly made up of most all of my Canadian income payers, and my RRSP includes my US income payers, most all of my US stocks actually, and then inside of my taxable account, I keep most of my pure growth plays. And why is this? Well, for one, I can defer capital gains tax, which I can't do with dividend income. Dividend income is taxed in the year you do receive it. And secondly, capital gains tax, when I need to utilize it, is actually a more tax-friendly situation than dividend income. So the first stock we're going to look at today, and actually one of my longest standing holdings, I have owned it for a very long time, and that is Fortis. They trade under the ticker FTS on the TSX. Now, you might be wondering why I would highlight a utility right now, especially when we're going to see interest rates rise, but the thing about it is Fortis is so reliable that it often actually doesn't trade with the ebbs and flows of interest rates. You know, most utilities are taking a lot of damage right now in terms of share price because of rising interest rates. These are companies that have very high capex. They invest a lot of money back into the business in terms of infrastructure, and as a result, they typically have very high debt loads. So when interest rates go up, cost of debt goes up, which in turn leads to utilities struggling. But as you can see by this chart I'm going to show you here, with Fortis, this isn't necessarily the case. It has bucked this trend and it will more than likely continue to do so. Obviously, we can't guarantee that, but it should be able to. And why is this? Well, a ton of investors own Fortis because of its reliable earnings stream. And why has it done this? How has it been able to generate such consistent earnings over, a period of, more than 4 decades? And that is because of its regulated utility nature. So what exactly is a regulated utility? Well, this essentially means that Fortis provides the, power poles, the power lines, the meter boxes, the metering, the wiring up to the meter box. They own all this, and in return, they generally go to the municipality. They provide a rate that not only guarantees a profit for Fortis, but is also fair to the consumer. And another reason why these cash flows are so consistent is because Fortis owns these means of transmission, it is almost impossible for another utility to enter that space and take market share away from Fortis. And 99% of Fortis's earnings come from regulated utilities. So Fortis often gets lumped in with Canadian Utilities. And why is that? Well, Canadian Utilities has a 50-year dividend growth streak. It just hit Dividend King status, which is 50 straight years of dividend growth. But Fortis sits at 48 years, so it is 2 years shy of hitting that mark as well. And as the two top dividend growers here in Canada, they often get lumped into the same category. But the one thing about Fortis and Canadian Utilities is Fortis is hitting that 50-year mark with stride, while Canadian Utilities is really, really struggling. When we look in terms of dividend yield, Fortis yields around 3.5% at the time of filming this, and Canadian Utilities is in the high 4% range. But the thing is, we can clearly see a slowdown in terms of both revenue and earnings growth from Canadian Utilities. And this is in the end impacting the dividend significantly. It is not seeing a large boost in dividend growth, whereas Fortis sticks with a 6% typically dividend growth guideline, and it hits it almost every single time. The company typically targets a payout ratio in the 70% range, and on a trailing 12-month basis, this is actually pretty high considering its payout is only 51%. So there is a chance that we could see even further growth from Fortis moving forward in terms of the dividend. Now, in order to show you a highlight of how true of a compounder Fortis really is, if you had invested $10,000 into this company in the mid-1990s, you'd be sitting on $286,230 right now. This is some insane level returns, especially from a company that's cash flows are so reliable. No, it doesn't provide the flashiness of a high growth tech stock, but this is a company that is going to be very consistent and is one of the reasons why it's one of the largest holdings inside of my portfolio. So you're going to see some pretty weird, funky ratios when it comes to payout ratios in terms of free cash flow for utilities. Right now, Fortis actually has negative free cash flow, but this is because the company is reinvesting heavily back into the business to take advantage of lower rates. When rates start to rise, it's very likely they'll dial back capex and the payout ratios will become a little more clear. I don't foresee a dividend cut in Fortis's future. I think they'll easily hit Dividend King status and will remain one of the core holdings in my portfolio moving forward. If we look to estimates in terms of revenue and earnings, we're looking to see, low single-digit revenue growth with, mid to high single-digit earnings growth, which is pretty typical of a utility like this. It's not going to grow at a crazy rate. And in terms of valuation, we can see here it's trading at about 20 times forward earnings, which is pretty expensive, but this is definitely the old Warren Buffett quote. It's better to buy a wonderful company at a fair price than a fair company at a wonderful price. I will continue to dollar cost average into Fortis for probably the duration of my investing career. With that being said, let's move on to the next stock, which is something we don't really speak on, and it is an oil and gas play, Canadian Natural Resources. So full disclosure, I own Canadian Natural Resources through the ETF XEG. I took a position in, I think it was mid to late 2021, around the $8-9 mark, and it's worked out fairly well for me. I am not bullish on the oil and gas industry long term, but I do understand the benefits to investing in the industry over the next 2 or 3 years as the demand for oil will no doubt rise. And I don't think there's a better major producer in the country to take advantage of this than Canadian Natural Resources. This is the biggest oil company in the country. It has rock bottom break-even prices, much better than other major producers like Imperial Oil and Suncor, and it was probably the most resilient company through the COVID-19 pandemic. As we saw companies like Imperial Oil keep the dividend steady, we saw Suncor cut the dividend, we saw many junior producers cut the dividend as well. Vermilion Energy, Whitecap Resources, they all cut the dividend and their share prices absolutely plummeted. But Canadian Natural not only kept the dividend steady, they raised the dividend. In the midst of the pandemic, this company added on to its multi-decade dividend growth streak, and that is because the company is extremely efficient at generating cash flow in virtually any oil environment. So this is a company that stayed cash flow positive in 2020 in the midst of literally collapsing oil prices. It still had free cash flow of over $2.2 billion in 2020. And in the last quarter, just its most recent filing, it generated more free cash flow than it did in 2020 and 2019 combined. So as a dividend investor, why is this important to you? Well, I really think these oil companies, not necessarily just Canadian Natural, but the other major and the other intermediate and junior producers, they're going to look to return that free cash flow to investors. I don't think right now many oil and gas investors want these companies to be expanding that rapidly. So in my opinion, investors are going to demand that this free cash flow be returned to them in the form of a dividend. Many oil and gas investors have been burnt significantly leading up to 2021 and 2022. So now they'd much rather see that cash flow returned to shareholders. So there's a chance we're going to see some big dividend raises from oil companies moving forward. And I think Canadian Natural is the best major producer, the one with the highest chance of outsized dividend growth moving forward. It yields around 3.62% at the time I'm filming this, but the most interesting part is Canadian Natural Resources dividend is only 36% of trailing 12-month cash flow. We can assume that at $70 WTI, $70 to $80 WTI, especially with the low $30 break-even point for Canadian Natural, that they are going to be generating a significant amount of cash flow moving forward. So I would expect this free cash flow payout ratio to actually dip. And I think we're going to see some big dividend growth from Canadian Natural moving forward. I own XCG because I didn't necessarily want to isolate myself to a single company, but if I were to be forced to pick a single oil and gas producer, I would pick Canadian Natural right now. I believe it's best in class, and it provides a, not as high of a return as maybe a junior or intermediate producer, but certainly has less risk as it's proven to be able to operate in virtually any environment. So everybody, last but not least, certainly not least, is one of Canada's biggest telecom companies. In fact, it is the biggest telecom company in Canada, and that is BCE. They trade under the ticker BCE on both the TSX and south of the border. Now, if you want to look at one of the best dividend compounders and overall growth compounders in the country, look no further than BCE. If we look at this chart here, we can see that around the same time, $10,000 invested in the early to mid 1990s. If you had simply reinvested the dividends and held this one, you would be sitting on returns of $443,850. This pretty much means if you had invested in, even $20,000 in BCE in the early 1990s, you'd be funding your retirement right now exclusively with BCE shares. You'd be sitting on, just shy of $900,000. And this company has been, without a doubt, one of the best plays in the country for those who are looking for higher income. Do I think it is the best overall play for telecom companies in the country? No, I don't. I don't own BCE right now, but I can definitely see the attractiveness of this company for those who are looking for high yields in the telecom sector. So when we think about TELUS, we think more of a Western Canada exposure, and we think of Rogers, we think more of Eastern Canada. I know here in Western Canada, especially in Alberta, TELUS is by far the most prominent telecom company. Rogers, not so much, although they still do have a bunch of exposure here. But with BCE, it kind of seems like they are are countrywide. And they are truly a diversified telecom company. If we look to overall exposures in terms of revenues by product and segment, we can see that 37% is wireline broadband and television, 14% being wireline voice, 38% being wireless, and 11% being Bell Media. It has a network footprint that pretty much covers 99% of the country, so it is highly unlikely, if you're looking for services, that BCE does not offer service in your area. When we look to the actual dividend, this is a company that yields 5.27%. It's the highest yield in the telecom sector, and it has a dividend growth streak of 13 years. But this dividend growth streak is actually, it's kind of a technicality. The Ontario Teachers Pension Plan, a purchase fell through of BCE back near the financial crisis, and as a result, the dividend was frozen and BCE lost its dividend growth streak. If that were to have not happened, BCE would very likely have a 20 plus year dividend growth streak and would have one of the longest dividend growth streaks in the telecom sector. Over the last 5 years, it's raised the dividend by about 5.1% annually, and it does right now, much the same as Fortis, have very high payout ratios. But again, this is a company much like Fortis also that will be impacted by rising rates due to the fact that infrastructure is so expensive and also requires a lot of debt to be taken on by the companies, especially when we look to things like 5G expansion. So once interest rates rise, it's very likely that these companies will dial back capex and payout ratios will kind of look a little bit more realistic. But I really don't see BCE cutting the dividend anytime soon. Actually, I think they're going to continue raising it. And BCE has been somewhat thrown under the radar, over the last 5 or so years. It's heavily underperformed a company like TELUS, but in 2021, it was the best performing telecom out of all the majors. And, who knows what we're seeing moving forward in 2022. BCE certainly presents more value from a price to earnings perspective than a company like TELUS and even a company like Rogers. So will people continue to buy BCE, the higher yielding option, over TELUS, the high growth option? Who's to say? It's actually pretty hard to figure out. I'm not a huge fan of Rogers. The dividend growth mess up that they had a few years ago, it kind of gets messy, and the internal issues that they've had recently. For those reasons, I'm not really a fan. But BCE and TELUS, considering these big three telecom companies own 93% of the market share here in Canada in terms of wireless television, internet, things like that, mobile, their economic moat is up there with the rail lines in terms of almost impenetrable. I mean, we've saw Verizon tried to enter the space. Shaw has continually tried to enter the space until they got scooped up by Rogers. I really don't foresee, anybody taking market share away from these three telecom companies. And as a result, I think their dividends are going to continue to grow over time. And if you're looking for a high yield option, BCE certainly presents that and is one of the largest companies in the country. So everybody, that's it for the video. 3 options for your TFSA. Obviously, you could do whatever you want with your own TFSA. But again, I put all my Canadian dividend stocks inside it. I reinvest those dividends back into the companies, and I let my TFSA compound, over the next 10, 15, 20 years. And ultimately, I'll cash out some very nice income in retirement. These are 3 options among many. Drop your comments down below and let me know what you really like. What have you recently bought with your new TFSA contribution room in 2022? And remember, if you drop a comment down below, you like the video, you subscribe to the channel, you are entered in the giveaway for our February subscription. So with that being said, hope you enjoyed the video and we'll see you next time.